All right, welcome back. It's the Avid Investor Podcast with me, your host, Josh Adamek. Today we're on episode 45, and I'm going to talk about Grant Cardone and Cardone Capital. Reason for that is I get a fair amount of people that reach out to me, or meeting with somebody, tell them about my business, tell them what we do, and a lot of times they'll say, or I'll get the comment, "Oh, you do what Grant Cardone does," and the short answer to that is no. I don't do what Grant Cardone does. My business, while there are some similarities to what we do and what Cardone Capital does, it's not the same. We're not the same model. We're not the same structure, and I'm going to tell you why. So let's get into it. Here goes. First off, what I want to start out by saying is I think my thoughts in general on Grant Cardone is I think Grant Cardone is an expert sales trainer, and he's an expert marketer. Fantastic, phenomenal. He's got some really cool stuff, some really cool teachings, trainings, books on sales and marketing, and what they do with their internet presence and all that. Like they're all over the place. So if you guys haven't read this book, I'd highly recommend reading this book. The 10X rule by Grant Cardone, talking about growth and, presence and creating the omnipresence. And, that's one thing that he has been successful at, is creating the omnipresence. And if you don't know what the omnipresence is, go ahead and read the book. This thing is motivational, to say the least. So getting into that and talking about the growth and 10X this, 10X that, why, think big, blah, blah, blah. It's a great book. If you're looking for some business type motivation, or just motivation in general, there's some good stuff in there. So again, Grant Cardone comes from a sales training background, and let's just clear the air now. Let's just get this out there. I don't follow a lot of these internet gurus, these guys that are out there. So I don't know everything that the guy does. I don't watch every video that comes out. I don't go to the website. I don't read every blog that's written. I just know what I know about Grant Cardone and Cardone Capital, because he has been successful in creating the omnipresence. So it's very hard to open up and scroll through social media and not see something out there. And, I'll scroll through it, I'll look, but I don't go looking for that. I'm not, like a big follower where I read everything that comes out. I don't see every deal that they do at Cardone Capital, but I see stuff that's out there, and certain things catch my attention, and I follow along when sometimes when I see that. So I'm going to give you my take, my opinion, my thoughts based on what I know, not based on everything that's out there and everything that they do, because I don't know everything that they do. So again, I've read the book, the 10X rule. I would recommend it. I think it's a really good book. I think there's some other stuff that he has out there that's really good as far as sales training and marketing and growth and stuff like that. I think Grant Cardone is very good when it comes to that. When it comes to sales training and marketing, and he's very good at sales. He's very good at marketing, which makes Grant Cardone very good at raising money and buying apartment buildings, which is what they invest in. So, again, if you guys don't know who Grant Cardone is, which if you're following along, if you have an interest in real estate, you've probably heard the name or seen what he's doing, and because again, he has created the omnipresence, is what he calls it. So. Check it out, follow along if you choose. I'd recommend reading the book. But as far as the comment, like what, when people ask if what I do is the same as what Grant Cardone does, is my business the same as Cardone Capital? The answer to that is no, totally different. The structure that we have and the investment strategy that we have are totally different. So Cardone Capital, what we do at Avid, what I do at Avid is many of you guys know if you follow along, we're small, much smaller company that operates under a private equity model. We work one-on-one with high net worth, accredited, and institutional investors to create and manage portfolios. The portfolios that we invest in are single family homes. What I feel is the most safe and secure asset class available in the market, regardless of market conditions. So where we differ from Cardone Capital and what Grant Cardone does is they invest in high-end Class A multifamily apartments. And I feel, my opinion is that's a very risky part of the market. I don't follow along with what they do. I don't see every deal that they do. I'm sure there's some really good opportunities out there. And again, when you're in the business, the old saying is the deal of a lifetime comes around about once a year. Same holds true regardless of what business you're in. If you're constantly out looking for deals, looking for opportunities, you're going to find the quote unquote deal of a lifetime. And, we do that regularly, consistently with purchasing single family homes. Those same opportunities may present themselves in the multifamily world. I'm not in the multifamily world. I don't buy big Class A apartment complexes. I don't buy small to mid-size apartment complexes. We invest in single family homes because, again, I feel that is the most safe, secure part of the market. Regardless of market conditions, if you know the market, and I talk about this all the time, market conditions, market cycles, if you understand market conditions and market cycles, there's, growth, prosperity, recession, depression. We, over the last 5, 7, maybe close to 10 years, we've been in the growth, prosperity phase of the market. And, over the last couple of weeks, the last month or so, that I wouldn't even suggest that we're heading into a down market, but we have seen a stabilization in the market, sort of a plateau. And that's just the world that we live in. Is my business going to be affected by that? No. I mean, we buy single family homes, regular houses, regular neighborhoods, regardless of what part of the market we're in, what phase of the market cycle we're in. There's always a need for single family housing. So in a down market, in a recession, depression, first off, do I think we're going into a recession or depression? No, absolutely not. But in a down market, in anything other than a market that's going up, our business model still works. I mean, we're still able to buy single family homes. We're still able to keep our single family homes occupied. And if anything, in a down market, our model works better. So, and there's several reasons for that. But, when we talk about, if I can tell you what I know about, or what I understand about Cardone Capital and their investment strategy is, Cardone Capital has seen tremendous growth over the last, I'd say, handful of years, 5 to 7 years. I just looked on the website. They're posting out there that they have 5 billion AUM right now. And if you don't know what AUM is, that's assets under management. So they have $5 billion assets under management. I don't know the time frame, but I vaguely remember it was only a few years ago, within the last 3, maybe 4 or 5 years that Grant Cardone was out there all over the internet talking about having 1 billion AUM, $1 billion assets under management. So over the last, let's just say 5 years, they've went from 1 billion AUM to 5 billion AUM. 5 times what they've had, 5x their growth. So that's great. It's phenomenal. That requires a lot of work to get 5 billion AUM. However, my opinion on that is, they're investing in Class A apartment buildings, and their investment strategy is to, first off, they're buying Class A apartment buildings. That's what they're investing in, Class A apartment buildings. So if, in my opinion, is that Class A is very contingent on market conditions, and the performance of Class A real estate is very contingent on market conditions. So when you're talking about over the last 7, 8, 10 years, we've been in a rising market, and a company like Cardone Capital or whatever other equity fund is in that growth mode. But while the market is rising, what's going to happen when the market changes? Because the investment strategy that they have is they buy a Class A apartment complex, and they buy it at a certain cap rate, and they increase the NOI, the net operating income, by adding amenities, pushing rents, adding different services to the complex where they can increase the NOI, which ultimately increases the valuation of the property. And then they would then refinance the property at a higher NOI, or exit the property, sell the property. And that's great. I'm sure they've done plenty of deals where they've made money, and they've had some success. However, what's going to happen when you have all these apartment complexes under management, and there's a shift in the market, there's a change in the market cycle? So those in my opinion, those Class A apartment complexes, they are very it can be a very risky part of the market to be in. And why is that? So when you invest in one of those fund type structures, so let's first off talk about that. When you invest with a company like Cardone Capital, or one of these other REITs, or one of these other private placements, what they do is they identify, let's say it's a $20 million or a $50 million apartment complex. Well, they have the capital stack needed for that, which is debt and equity. And if you're investing, you're coming in as an equity investor. So if 20% equity is needed, on a $50 million purchase, they need to raise $10 million in equity, and they're going to use 80% debt to purchase that property. So they're going to raise $10 million with a private placement, a fund type model, and bring in $10 million in equity. So if you invest in that type of deal, you may come in with 10,000, 50,000, million, 5 million, whatever. You're a part of that equity raise, and you become an equity partner. I believe that's the structure. You become a minority equity partner. So your money is invested in the equity portion of that deal. Well, there's a big debt piece that goes along with that. And the property is purchased at a certain cap rate, close on the property, and then the company goes in and they try to increase the NOI to increase the valuation of the property and get that big spread. And again, that's that's possible. That happens. That can be done. One that requires to first find the opportunity. And when you're buying the Class A, the large multifamily properties, those those deals, while those properties are traded, you're typically buying from another large company that has, one, either built and developed that complex, or two, has owned that complex for a very long time. And when you're buying multifamily properties, you're buying based on the numbers, based on the financials. It's bought at a certain cap rate, it's sold at a certain cap rate, and things like that. And it's very difficult to find to come across a quote unquote distressed seller, distressed sale. I mean, it's bought and sold based on the financials. I mean, people don't just it happens, but people don't just own a large multifamily property by accident. It's something that requires a lot to get into. So you don't just random people don't just own 400, 500 unit apartment complexes. They typically aren't just inherited. There aren't a lot of distressed, undervalued opportunities out there. So when you talk about, and a lot of those, and what I mean by that is a lot of those investments are, contingent on market conditions, market cycles. So if the market is continually rising, the market is continually going up, valuations are going to continue to rise and continue to go up. But nobody has a crystal ball. Nobody knows when the market will shift or change. So if we're in a rising market, which we've been in for the last, several years, you can buy one of those, you can invest in one of those multifamily assets, and you can go in, you can increase the rents, you can push the rents, you can increase occupancy. There's a market for it now. You can increase occupancy, you can add different amenities, and you can raise that NOI, which raises the valuation. But let's just say, for example, you get into one of those multifamily investments and the market changes. As we've seen over the last month or two, interest rates have gone up. And when interest rates go up, I mean, that really, really affects, the capital stack and the valuation on those properties, on commercial assets. So, and of course, when you get into those properties, there's going to be a certain structure on the financing where rates are locked, things like that. But when the renewals come due, typically there's a 5-year rate lock, 10-year, maybe a 10-year rate lock. But when those interest rates adjust on those large multifamilies, that really, really affects the valuation of the property. And then occupancy is a big factor in those. So let's just say you're in a area, that's overdeveloped, overpopular, or that's a high growth area, and you're investing in a multifamily property, and the market's good, financing is available, there's cranes in the sky everywhere you look, multifamily going up. And then we get to the point where, the market stabilizes, the market changes, and occupancy is affected. Well, if occupancy is affected on your large multifamily property, the valuation of the property is affected big time. So there's a ton of factors that you really have to look at and you really have to understand when you're investing in multifamily housing. And while the numbers are big, the properties are beautiful, absolutely, there is money to be made in those opportunities. But in my opinion, that's a very risky part of the market to be in, because it's 100% contingent and subject to market conditions, market cycles. And when you look at companies that have grown substantially over the last 5 to 7 to 10 years, a lot of their growth has been dependent on the market conditions. The market constantly, the market consistently rising over time over the last several years. And my fear is that when the market stabilizes, shifts, begins to, we begin to head into, I don't want to say a down market or a recession, a depression, but a market that isn't as rapidly growing and increasing as it has been. Some of those opportunities in the multifamily world may not perform the way they're projected to perform. And when you're investing in in an opportunity in a multifamily or a commercial project that has a lot of debt and a lot of equity, and while the margins, the numbers may be big on those property, on those opportunities, because the projects are so large, the actual percentage of profit margin, there may not be that much there. When you start to look at occupancy potentially being affected, rents, that may have to be lowered to keep the occupancy up. I mean, all of those things are going to affect the NOI and the valuation of the property. So again, well, my opinion, take it for what it's worth. I feel that my opinion is that Grant Cardone is, again, an expert sales trainer, expert, marketer. Guy definitely knows how to run a business. But like when it comes to the investment strategy itself, it's not necessarily something that I agree with it. Does it work? Yes, it works. Absolutely. Are there huge companies out there that are way bigger than me, Grant Cardone included, that have seen success in this model over the last 5, 7, 10 years? Yes, absolutely. Is there money to be made in investing in multifamily and commercial real estate? Yes, absolutely. There's money to be made. However, when you're investing in those assets, in that asset class, just beware. A lot of times those assets are 100% subject to market conditions and market cycles. So just wanted to throw that out there, that when you're looking to invest, whether that's into a REIT or a fund or, something like that, just take a very, very close look at the asset class that you're investing in, and just be aware that really do your due diligence and really understand the asset class and the potential upside, and also the potential downside. Now, the thing that's attractive to a lot of people investing with someone like Grant Cardone or one of these REITs or a fund model is, they are a lot of these times, a lot of these opportunities are open to both accredited and non-accredited investors, which means, if you're a non-accredited investor and they do a fund for non-accredited investors, you can get into one of these opportunities with $5, $10, $25, $50,000, which, don't get me wrong. I mean, that's a lot of money, to put 25 or 5, 10, 25, $50,000 into a fund, into a REIT. That's a lot of money for some people. That could be a big chunk of their investment portfolio. So just understand that, there's more to look at than just the bells and whistles and the bling and all that stuff. You might feel good about putting 25,000 in or 50,000 into a REIT that's going to buy this big, massive apartment complex in Miami or wherever that has 400 units, 500 units, and the pool and all the amenities. But just understand that those opportunities have done well for a lot of people over the last, 3, 5, 7, 10 years. However, look back to 2008. Look back to the last time that we've had a major correction, and take a look at the performance of those investments and see what happened with those large multifamily properties, with the large commercial deals, and a lot of times with those. You have to understand that, when you invest in real estate, you know, depending on the structure, you may go into one of these opportunities, and I'm not going to say that the sponsor is going to go bankrupt and go out of business or anything like that. Does it happen? Yes, absolutely, it happens in the commercial world, well, really in any part of the market. But I'm not saying that you're going to invest in this and you're going to lose all your money. I'm not suggesting that. Can it happen? Yes, absolutely. But the performance and the projections may not be there if we go into a down market, if we have a correction in the market. So again, the market cycles: growth, prosperity, recession, depression. If we go into a recession, depression, into a down market, the valuation on those properties are affected. Absolutely, they're affected if we go into anything but a growth, prosperity part of the market. So if you're investing in that, you got to be in it for the long term. Investing in real estate is a long-term commitment. It's a long-term investment. So you got to be in it for the long term, and you have to understand the structure of the deals that you're in. When you're investing in an opportunity that has a heavy debt piece, you're also at the mercy of the banks. There's a possibility that, depending on the capital stack and the structure with the banks, banks call loans due. Things happen. If you get into one of these big opportunities and the market's affected, and you're in one of these parts of the country that has crazy ups, crazy downs in the market cycles, banks take properties back. It happens, when occupancy starts to drop big time, there's not sufficient income to support the debt service. These are things that happen in the commercial world. So just understand that. Am I saying that every commercial investor, every multifamily investor ends up going bankrupt? No, I'm not even suggesting that. But, it does happen. So it does happen. So just what I'm telling you is, when you invest, when you see these REITs, when you see these opportunities, when you see these funds available, just really do your due diligence and really understand what you're investing in, what you're getting for your investment, and what the collateral is, what the security is on that investment, and understand the capital stack and the structure. So again, these projections in these funds, the REITs, the private placements, they may project, way above average returns, double digit returns, blah, blah, blah. However, just understand that those returns, those projections may very well be contingent on market cycles, market conditions. So, that's it. That's my take on multifamily investing. And again, I'm not saying it's bad. I'm not saying there's anything wrong with it. I'm just saying that, before you invest in one of those opportunities, do your due diligence and really, really understand what you're investing in. So, again, with what we do at Avid Private Equity, Avid Management Group, is we focus on single family homes, regular houses, regular neighborhoods. We call Grandma's house B-class neighborhoods in and around the Pittsburgh market. We do that for several reasons. One, our focus is safety and security for the long term. So we do cash heavy investments, very little to many of our portfolios use no bank financing, no leverage. The focus of our model is safety and security. So we invest in single family homes, regular houses, regular neighborhoods, B-class neighborhoods. Are we investing in those cool, flashy, sexy multifamily properties that have the pool, the gym, beachfront, riverfront properties? No, that's not what we do. We buy the 1,200 square foot box, 1,000 square foot brick ranch or 2-story that's in Pittsburgh. It in no comparison it doesn't compare to the multifamily, the flashy, the big complexes. But reason why we do that is B-class neighborhoods, single family homes, regular houses, regular neighborhoods. There's always a need for single family housing, regardless of market conditions, regardless of market cycles. There's always a need for a $1,200 to $1,500 a month single family home in Pittsburgh, or any B-class neighborhood, any median price point. There's always a need for that type of housing, regardless of market conditions. So that's what we focus on. Do I come across opportunities in development, in multifamily? Occasionally, something comes my way, but that's not what we invest in. Our focus again is safety and security. So do we hit those crazy 20-25% returns where we go in, we buy a property, and we increase the NOI, and we raise the valuation and then exit no, that's not what we do. Again, because our focus at Avid and Avid Management Group is safety and security. Just buying bricks and mortar real estate for the long term. We underwrite properties, we buy properties, we know they're going to perform, we know they're going to do well. If the market adjusts, we know our properties are going to perform, we know our investments are going to perform. There's always going to be a need for single family housing. So again, that's my take. I just want to throw that out there. I want to talk a little bit about Grant Cardone and Cardone Capital and similar REITs, funds, PPMs. And again, are there opportunities to invest with those folks? Yes, absolutely. There's opportunities to invest with those other companies. Is there opportunity to make money investing with those companies? Yes, absolutely. There's money to be made. Just understand, if you invest, regardless of who you invest with, just understand the asset class and what you're investing in, and just truly understand the risk reward ratio that goes along with that. And just before you invest, just make sure that the risk profile of what you're investing in matches your both short-term and long-term goals. So if you want to go into, one of these multifamily opportunities, a development opportunity, spec development opportunity, by all means, there's money to be made in those opportunities. Just understand, whatever you invest in, just truly understand the asset class, market conditions, and the risk reward ratio that goes along with that, and make sure that matches that risk profile, and potential return matches your personal strategy, your short-term, your long-term goals. And if you like the cool, sexy, flashy multifamily, or the spec development, the land deal, whatever, you like that, and you understand the risk that goes along with it, and by all means, invest in those opportunities. I'm not telling you not to. I just wanted to throw out there that with any investment, there's some level of risk. So just make sure that that level of risk, is in line with your both short-term and long-term goals. So that's it. I don't want to talk too much about it, but again, just to recap, on Grant Cardone, Cardone Capital, again, if you haven't read it, if you're watching the video here, I got the book here. If you're on audio, the book is The 10X Rule by Grant Cardone. It's a phenomenal book. It really is. It's a motivational book as far as business growth and marketing and creating the quote unquote omnipresence, which I feel he was very successful in creating the omnipresence. I feel that Grant Cardone is an expert when it comes to internet marketing. I feel he's an expert when it comes to sales training, sales and sales training. He's got a lot of good stuff out there on marketing, sales, and sales training, which in turn is why he has been so successful in growing Cardone Capital in the business, because he's created the omnipresence, and he has the following and the marketing on locked down. So again, give the book a read, and take a look at what he's done. I mean, he's seen tremendous growth over the last 5, 7, 10 years, whatever it's been. But I just wanted to give you my take on Grant Cardone as far as marketing, sales training, and then, the investment strategy. And again, the investment strategy that they have, they've done tremendous things over the last 5, 7, 10 years with Cardone Capital and building up, 5 billion AUM. That's no joke. That's a lot. That's a lot of assets under management. In the grand scheme of things, when it comes to like the private placement world, and the fund world, 5 billion AUM really isn't that much, comparatively speaking, compared to, what I do and what, a lot of folks do in this industry. It is a lot, but there are funds and there are REITs that are much bigger than that out there. But again, Grant Cardone has created the omnipresence, and he's out there. He's well known. The name comes up all the time. So I just want to talk a little bit about it. Again, there's opportunities with what they do with their private placements, opening up their funds to accredited and non-accredited investors. It gives some folks, that want to get into those type of opportunities that don't have, a ton of investment capital available. It gives them the opportunity to get in and be a part of something really, really big. Just understand, make sure you understand that, while with your investment capital, you're, 5 or 10 or 25 or $50,000, that may be a lot of money to you, but in the grand scheme of things, it's a very small piece of the deal. And just understand that, make sure you truly understand the risk profile and the asset class that you're going into, and understand market conditions, market cycles, and things like that. So that's it. That's my take. Again, I give Grant Cardone a ton of credit for what he's done and what he's built up over the last 5 to 7 years. While I may not necessarily agree with the investment strategy that they do, I feel that they've obviously made a lot of money over the last 5, 7, 10 years. And while I may not agree with the investment strategy, just because it doesn't match, my strategy and my risk profile, it may work well for a lot of other people. So that's it. That's my take. Thank you guys so much for tuning in. It was episode 45 of the Avid Investor Podcast. So thank you guys for listening. If you find value in this message, and what I put together, again, I'm not, I don't have anything to offer you other than the content I'm putting out there. So if you find value, go back, listen to some of the other episodes, and share it with somebody that can benefit. And again, hit me up. I've got a lot of people reaching out to me recently, asking about the podcast, asking about different episodes. So if you've got any questions, any feedback, anything you want to run past me, shoot me a message. You can find me on social media, send an email, call, text, DM, whatever. Let me know what you think. And then moving forward, let me know, what you might want me to cover on future episodes. So thank you guys so much for tuning in. And that's it. That's episode 45. On to the next.